Welcome back to Good Revenue. We're here today with Davina Kale. She is a senior partner at Pillsbury, Winthrop, Shaw, and Pittman, and she has guided companies through high-profile IPOs and M&A activity over her long career. She is also the co-leader of the capital markets practice at Pillsbury, and it covers a wide range of sectors, including technology, e-commerce, life sciences, financial services, and retail. Some of the deals you might be familiar with include Everi, Dibs, and Coursera. Welcome, Davina. We're excited to talk about IPOs today.
Oh, thanks so much for having me.
We'll just jump right in. You have an incredible track record. You have helped so many different kinds of companies think through going public or conversations around their exit or M&A activity. And obviously in the market today, there is a ton of pent-up demand for IPOs. What is your sense of the market? And I'm asking you to fortune tell a little bit here, but what do you think is happening in the ether right now?
Yeah, I wish I had fortune telling abilities, but sadly, yeah, one of my many flaws, I don't have that. And of course, being a lawyer, I should say before we start, I will have to give a standard disclaimer. Any views, comments, or opinions I express on this podcast are my own personal views. I am not speaking on behalf of any other entity, and nothing I say should be construed as and does not constitute legal advice. Of course, we cannot give legal advice without retention, and any advice given is obviously would be client specific pursuant to an engagement. With that out of the way, in terms of the IPO market, I think there's some consensus that you are seeing signs of life 2024 and what I would call cautious optimism. I think there's a couple reasons for that. The first and foremost is exactly what you noted. There's pent-up demand. The IPO market's been pretty quiet for the last couple years, but you are seeing increased pressure among longtime investors in private companies looking for that liquidity event. I think in addition to that, you are starting to see more stability in the state of the financial markets and a little more visibility and stability in terms of interest rates and inflationary pressures. With all of those showing signs of being more stable and less volatile, that is more conducive to stable capital markets, which in turn is more conducive to opening an IPO window for private companies that are in the queue. At the moment, I would say that any increased activity would be more likely in Q2 and Q3 of this year, and then possibly on hold until 2025. We might see even more of an uptick in 2025. The main reason for that is an election season looming in the fourth quarter. I think people who want to get out are going to be motivated to try to get out before that, and otherwise they'll probably wait until the following year. You are hearing more chatter that private companies are starting to take, I'll call more affirmative steps to preparing themselves or positioning themselves for a potential transaction, just in case the IPO window does open up or is open up for a specified period. And again, that election season, I think, will have an effect on in terms of companies when they decide to go out this year versus 2025.
I think that's super helpful context. I'm sure there are people listening who are excited to hear there might be some movement. So one of the questions following up on that, it seems to me just as an observer that IPOs have changed just looking at the data. Do you think, as an expert, that the purpose of an IPO has changed over the past 40 years? Has the purpose changed, or is it just a cycle? Maybe I'll just share some of the data that I found. There is some information from the University of Florida, which I think is super interesting. And they noted that 78% of VC-backed IPOs in 1980 were profitable. And in 2021, that number was just 10%. They also note that in 2022, none of the 13 companies that went public were profitable. So just looking at the data, it seems like the tenor of why a company would go public has changed. What is your sense of that?
Yeah, I think it's interesting because I have seen some trends in terms of companies going public and at what stage in their life cycle they go public versus very early stage versus more seasoned companies. But I do think the overall purpose, high-level purpose of an IPO probably has been fairly consistent. Companies looking to go public are looking for more liquidity. They are looking to generally increase their profile, their visibility, and their reputation. Everyone perceives, obviously, cachet to being a public company listed on one of the major stock exchanges. Obviously, one of the main reasons is to facilitate access to public capital and better position a company to accelerate their growth going forward, essentially the next phase of their life cycle. But in terms of your specific question on profitability, I think these days it's less unusual for IPO companies to not be profitable at the time of the IPO, or even immediately out of the gate, or even within a year or two or three of becoming public. This goes back to dot-com boom. When I spoke about trends in my career, I've seen companies going out. We saw companies trying to go public within a year of being formed, within 2 years of being formed, clearly not profitable at that point. They were going public literally on a promise and the idea of the underlying technology and the company vision was cyclical. So you see the IPO window shut, you see some of those companies not perform well after becoming public. So when the next sort of phase or resurgence of IPOs, you started seeing companies that were a little more seasoned, 5 years, 10 years, 15 years operationally. Even then, I wouldn't say most of them were profitable, but they all had in common is that they all seem to have a trajectory or a path towards profitability and growth. And that, of course, that duration and how long that takes varies by industry, but they had a plan. There was a solid business model, financial model, and maybe more than profitability at the time of an IPO, there seems to be more focus on whether the company has historically had sufficient visibility and predictability in its business model with a track record of hitting its numbers. And obviously, as a private company, those would be internal numbers, but they demonstrate that in the course of the due diligence process. That gives you a little more confidence in terms of forecasting going forward, because many IPOs are valued on what they're expected to deliver post-IPO versus what they've accomplished prior, provides the track record, but the valuation is on a look-forward basis.
How much does the quality of revenue or the business model matter, especially if you're thinking about an IPO versus an M&A activity or some other track for the company?
Yeah, I think the quality of the business model matters maybe in a different way that you might be thinking or others might normally think about it. And when I say it matters, it touches on what I just talked about. The business model should be fundamentally sound. Fundamentally sound. Underlying assumptions of that business model are solid. It's based on the company's experience and track record. They've demonstrated historically that when they set out their internal targets, they've historically been able to meet or exceed those. That gives you confidence in that business model going forward, that again, fundamentally sound, solid underlying assumptions, and therefore there's confidence in valuing the company on its expected performance going forward after the IPO, a year, 2 to 3 years out post-IPO. Obviously, one of the things you'll hear emphasized in a lot of IPO meetings, you do not want to miss your numbers the first quarter out of the gate. And certainly, ideally, you don't miss them at all, ever, but you wouldn't want to miss them the first quarter or even the first year out of the gate. So it's critical that from the quality of a business model, companies maybe want to focus on. There's other factors in a business model, obviously sales cycle and duration of those. I would say those matter too, but again, it would vary by industry. A tech company would have a very different sales cycle and churn than, say, just a pure retail company. Even if the retail company is selling online, the sales cycles are very different. In terms of those types of factors, you want to check the quality of other comparable companies in that particular industry and just make sure they're within the norm there. Obviously, being an outlier, hopefully there's a good reason for that. But in terms of those factors, I think that's what you would look at. Asked about M&A, and I would say a lot of companies will pursue a dual track process. So they'll start an IPO process, but since a lot of the work can be leveraged into an M&A process, some companies will do that because it makes the most sense for them. If the market is a little choppy, it makes even more sense. Sometimes once it's well known that a company has started down the IPO path, if they've done a public filing, that actually brings suitors out of the woodwork. And that will accelerate the M&A process as well. But overall, the type of diligence from a business model financial perspective is pretty similar with respect to an IPO and an M&A transaction. I would say it's pretty similar in terms of the level of detail and the breadth of scope of the due diligence. So I always advise companies, if you're thinking at all about a dual track when we're putting together your due diligence materials, keep it both in mind, but it will largely overlap. I always advise people, don't be surprised at the level of digging people will do on both transactions. The bankers, the lawyers, et cetera, everyone's going to get in there. Make sure your house is in order. And you should expect to be able to answer any and all questions that arise from the materials that you produce for their review.
Does that also mean that you should look at diligence as the seller or as the owner seeking to IPO the same either way?
Yes, I would say it's the same. It's extremely broad, deep, and detailed. I think one of the things I try to advise companies who are undertaking an IPO process and also in an M&A process is you might be a little shocked at how thorough some of this due diligence is, but it's actually a good opportunity, especially if you start ahead of time, to get your own house in order and put certain processes and procedures in place so that when the time for a transaction actually hits, you've already done your corporate housekeeping. You've already cleaned up anything you had to clean up, identified any holes, gaps, anything of that nature. You've already dealt with it. Any little issues you uncovered as part of compiling your own due diligence, get that resolved ahead of time. By the time other parties are coming into the deal, they're just reviewing and asking questions. Red flag items will be raised because to the extent there were any items raised, they will have been dealt with ahead of time.
This is a great segue to one of the other questions I wanted to talk about. How far in advance should companies be planning for exit? And when should they bring someone like you in or advisors in general?
Yeah, so this is a question I get all the time, and it's a totally understandable question because I always try to put myself in the company's shoes. Try not, as hard as it is, I tried not to think like a lawyer when I'm talking with companies about preparing for a potential IPO. Our answer as lawyers is obviously, oh, the sooner the better, as early as possible. Get ahead of the game. As soon as you incorporate, start thinking, make sure your house is in order from there so we don't have to do a lot of cleaning up later. But the practical reality is it's an expensive process. Every company wants to be mindful of their financials. You don't want to start spending money on a particular work stream if you think the likelihood of that is still 50-50, but you'll have more visibility, and that visibility might get to 80-20 12 months from now. So maybe you'd rather spend the money there. As a general rule of thumb, I tell companies 6 to 18 months in advance of an IPO is when you should start preparing and planning, ideally bringing your counsel if it's a company that we haven't represented since inception. Some companies might decide to switch, some might not. If companies are thinking about specific IPO counsel, I would say start thinking about it 6 to 18 months in advance. It's because the law firm and your other advisors can help you with that planning process. And I call it sort of project planning, and help you kind of budget, saying these first few months, we focus on this. That average cost is about this. So if you don't think it makes sense, you can defer that cost. So we generally provide companies with a template project plan. I say 6 to 18 months, and you're thinking, that's a pretty big window. Why is that? And I would say that depends on how far along a company already is in terms of its own IPO readiness preparations. Some companies already started internally preparing. By the time they're looking for counsel or investment bankers or even potentially changing audit firms, they've already put a lot of things in place. Other companies haven't focused on it at all, and suddenly the market turns and there's an opportunity and people are calling them and saying, when are you going IPO? In those cases, the sooner the better. I probably shouldn't say this, but it is not infrequent, notwithstanding my 6 to 18 month rule in terms of planning in advance and getting advisors in the door, including legal advisors. It is not uncommon for companies to reach out to law firms, including our law firm, much closer in time to an IPO launch. The least amount of time in my case was literally 2 weeks before having the entire group start the process, and we're brand new to the company. So I would say 2 to 4 weeks is not unheard of, but if you have the luxury of some advanced visibility, 6 to 18 months is ideal. That gives you a runway to accomplish a lot of things ahead of time. I can get really granular, but I should probably stop there unless you want more information on that. But there's a lot to do. If you give yourself that time frame, you have a plan, it helps from an organizational and efficiency perspective, both time and cost. The overall goal should be that a company starting an IPO process in a perfect world is already functioning as a public company before that IPO process even gets started. Because the actual IPO process is about a 4 to 6 month process. you're going to be so busy doing the IPO and running your business. All that other infrastructure for being a public company should already be dialed in, and you shouldn't have to worry about it. Now, easier said than done, but that's the overall.
I think that is super helpful. I'm still laughing that 2 to 4 weeks, and that's possible. I
wouldn't advise
incredible.
it, but it can be done.
No, that's amazing. I'm also assuming taking a little more time would actually improve your odds of getting the IPO results that you want. Is that fair to say? Or is it that in the case of a company that's a month or less, really there's just a window of opportunity they see, and so they're just going to hop?
I will say there have been very successful IPOs done where it was hurry up and get started with very little lead time, again, 2 to 4 weeks before there's a kickoff meeting. And it can be done, and those companies can perform very well. I wouldn't advise it as a general rule of maximizing chances of success for an IPO. I think there's a lot of ways to measure an IPO's success. I defer to other much more knowledgeable experts in the area in terms of how do you define an IPO success by economics, stock price performance, and everything from that perspective. For a successful IPO from a deal execution standpoint, I think you're exactly right. That advanced planning and starting to think about we should start acting like a public company, even though we're still private, so that by the time we have a big organizational meeting with a lot of bankers, lawyers, and other advisors in the room, we've already got the systems, procedures, and infrastructure dialed in. Just that mentality of operating more like a public company versus a startup mentality, which is very different. I think, again, from an execution standpoint, being successful means you get that transaction done in a very efficient manner from a cost and time perspective. And very critically, if you plan in advance and are well organized, remember, this is still a company. You want your management team focused on running the company and ensuring that the company continues to grow and is successful. Yes, the IPO transaction is important and it's going to be going on in parallel. You want the management team involved, but if you have an orderly, organized process and you're planning in advance, you can really minimize the disruption to the management's focus on running the actual business, which is critical, right? You don't ever want to sacrifice how the business is doing because everybody's diverted on the IPO. I think a successful IPO transaction is executed where it's just humming along, almost in the background. And then as you get closer to the actual launch, things all come together. But it should just be humming along. Management weighs in when they need to, but otherwise can continue doing the most important thing, which is running the business.
I think that is super helpful. And it sounds simple, but I'm sure it isn't. You got to still bring in the business and make sure everything is worthy of going public. What do you think makes an IPO successful? Is there anything else? And the corollary to that is, what do you think makes an IPO harder to do in terms of things that are maybe preventable, or if a founder or the team knows about it ahead of time, they might be able to do some things differently?
Yeah, there's a lot of things. Some of this will be subtopics of organization and preparation, but one of the most important things is setting expectations, expectations across the board. Obviously, we talked about expectations about running as a public company and the rigors of being a public company. I often tell companies, depending on your company culture, that might be a bit of a culture shock. Companies have a wonderfully open culture. Many private companies, transparent, open lines of communication across the employee base. It's not just concentrated in senior management. It's one of the most attractive attributes of and strengths of companies generally, and especially private companies, startup companies in this area. Unfortunately, one of the byproducts of being a public company is you sometimes have to adjust that culture a little bit. You're subject to a lot more rules, regulations. I think everyone knows about material non-public information, leakage. Some people might be familiar with Regulation FD. That requires companies to narrow that open information flow and concentrating it, honestly, more in smaller groups, just to control what the company is saying, who's authorized to speak on behalf of the company. And that can be disruptive. So I always advise companies, try to get ahead of that. I would also say setting expectations in terms of the sheer amount of work, time, and cost involved in an IPO process. We've talked about it a little and cryptically alluded to a bunch of other advisors, but there's a lot of constituencies to running a successful IPO. Obviously, the company, the law firm, the auditors, the investment bankers, the PR firm, the IR firm, and there are other third-party consultants, IPO consultants, financial advisory and preparation consultants who have been extremely valuable and helpful on executing these transactions. So I think level setting expectations of what it will take. I just talked about the different constituents. When you put that team together, trust that team. They've probably been through a lot of transactions. They can be very helpful. Trust them. It is the company's IPO first and foremost, but it's okay to lean on the advisors and the team that you put together and trust their instincts and input on certain matters. One that's very granular, and I think people who have been on an IPO will probably be nodding their heads, is one of the most critical work streams is financial statements. The timing of an IPO and the ability to hit the timing depends on everyone being very realistic about expectations about the timing and availability of the financial statements that are required. We've been on many deals where some people just had it in their mind that they were going to hit a certain date, whereas everybody else was saying, yeah, but we're not going to get the audit done by a certain time. Open lines of communication, level set expectations, just recognize you're not going to be drinking from a fire hose. You'll be drinking from 10,000 fire hoses for the next few months. And at the end of the day, it will all be worth it, but just be prepared for that. You asked about things that might make the IPO process more difficult. Obviously, a lot of it is the converse of what I just said. I kept talking about being ready to be public. I should dive a little deeper so people understand it's not just the mindset, but literally infrastructure, operational software, financial reporting software, internal controls, internal disclosure controls and processes. Have that already baked in and just part of your company's DNA before you start the IPO process. There's also a personnel aspect to it. Many companies will have to augment their board composition and find boards of directors who meet qualifications required by the SEC or the stock exchange. Board members are in high demand. It often takes several months to find the right board members that the company is looking for. Sometimes that extends to management. Sometimes you have to supplement your management team. You'll need to hire people with SEC reporting experience. So if you wait till the end to do that, it makes the process more fraught with peril. So again, I think that's just the converse of being prepared that will help ensure a smooth deal. I think outside what you would normally expect for, I say things that can make a deal harder, factors within your control, factors outside of your control. And we just touched on factors within a company's control, preparation, hiring, infrastructure. Unfortunately, there are a lot of factors outside the working group's control, which literally will throw a wrench into a company's IPO timing. The most obvious is market conditions. I'd love to have a crystal ball on stock market performance because I might be retired 10 years ago, but market conditions, and not just overall stock market conditions, but specifically an IPO window. Market might be great, but the IPO window isn't necessarily part of that equation. And even if an IPO window is open, sometimes it's not open for the particular industry that your client is in. For example, maybe biopharma, life sciences, there might be an open window and a lot of appetite for those, but less so for semiconductor companies. And then the next year, that may switch around. This is some of the negative parts about going public, not unexpected if you file to go public. Sometimes that results in unanticipated litigation coming out of the woodwork. Depending on the type and nature of that litigation, that could slow things down. Economic conditions. These days, there's a lot of geopolitical issues in the world, outbreaks of hostilities, global pandemics and public health crises can also throw a wrench into an IPO's anticipated timing. Things that would have nothing to do with the company's performance, but can affect their ability to go out. And then more granular things in the course of actually executing a deal. Any IPO goes through an SEC review process. It could be that the nature and number of the SEC comments coming back might take longer than expected to resolve to the company's and working group satisfaction, to the SEC satisfaction. Some deals might entail other regulatory clearances as well. That sort of nitty gritty of running a deal is a little bit outside the company's ability to control 100%.
Have you ever had to rescue a deal? What is that like when you're actually in it?
I would say when you're in the throes of an IPO, I personally just assume that I'm not going to sleep for the next few months. Your lawyers are usually on 24/7. I would say when you're on a transaction, this is equally applicable to large M&A transactions as well. You're not really on 24/7. You're on 48 hours, 7 days a week, trying to squeeze and get as much work as you can. There's a lot of multitasking involved. I don't know if rescuing an IPO would be the right term. Any IPO involves a pretty big working group and lots of advisors. It definitely takes a village, and everyone has a very critical role to play. It's great when we all work seamlessly together. In terms of harrowing exercises on an IPO, some of these go way back, but there have been occasions where you're very close to pricing a deal. And for people who are less familiar with an IPO process, that time between clearing your registration statement and ability to price the deal is extraordinarily time sensitive. There's essentially zero room for error. If you aren't able to price when you want to, there's every chance that something happens in the market, you might never be able to get out, or you might have to wait another quarter. A lot of what I'll call, I don't know if I should call it rescue, but IPO crises and management have occurred in that time frame. One comes to mind where on a transaction, I think everyone was getting ready to price and things were moving along. Let's just say there was something inadvertent that caught the attention of the regulators, which prompted a very early oh dark 100 wake-up call to me as the issuer counsel, and basically said, Houston, we have a problem. And I, of course, wasn't really sleeping with one eye open anyway, because we were getting ready to price. Obviously had not been aware of this. This was, again, an unintended inadvertent issue that happened through another constituent within the working group. But nonetheless, because it happened, it became our problem. We had 3 hours to fix it or wouldn't have been able to price. And again, I emphasize the working group, notwithstanding that little glitch ideally would never have happened. The glitch happened. We got the phone call. Within 10 minutes, we had rousted everybody in the working group. This was between 4 and 6 o'clock in the morning. Let's just say we did what we had to do in those 2 to 3 hours to satisfy the regulators, get everything cleared, and hit the schedule.
Yeah, makes sense. At that point, you need to get it done, right?
Yeah.
So
you just need to get it done, and you are 1,000% tunnel focused on getting it done, and you're not worried about being popular. You're literally just barking at people that we have to do this and this to get it done. Similar things happen on deals. You read about these, but we talk about there's rules about publicity, and you're not supposed to be out there hyping a company right before an IPO except through permissible channels. And on occasion, there will be an impermissible hyping of a company that, again, will catch the regulator's eye. Oftentimes it happens when a company's on a roadshow or right before pricing, and the same fire drill happens. The councils would get a phone call. The councils are jumping through hoops, doing some negotiation with the regulators, filing a lot of documents just to get ahead of it and resolve it. But literally with zero, there's no time. My advice, I talked a lot about companies being prepared. My advice when we're working on a deal for our team internally is, I always say, we need to be prepared for every contingency, everything that could possibly go wrong. We have to have a game plan so that if it goes wrong, we're not working around trying to figure out how to solve the problem. We already have the solution mapped out, because you might have minutes. If you're lucky, you've got a couple hours to fix the problem. I say preparation. And my corollary to that is plan for all contingencies, even the most unlikely ones. After practicing for so long, I think I've seen every crazy contingency that might happen, but be prepared, because you never know.
it makes a lot of sense just going through the list of things that you've cited. Assume the worst and hopefully you won't have to deal with it, right?
Yeah.
For it. One other related question that's also a granular one, but I think it might be helpful to listeners. How would you recommend that people think about legal versus other advisory services? Because it's very clear listening to you that this really does take a village. I understand that in some deals, bankers are driving it. Maybe in other deals, you're leaning on the lawyer. How might you advise someone? Not that this is legal advice, but just in a general sense, how should they think about that to get the most value back for the company and through this process?
What I always think about, and I should confess, I'm a huge sports fan, so I'll use a sports analogy here.
You're not alone, I'm told.
Yeah, exactly. And yeah, it does take a village. And I've listed off like all the other critical advisors that play a very important role in executing a successful IPO. I would say the one thing about sort of the law firm, and by law firm, there's underwriter counsel and issuer counsel. For purposes of this, I'll talk about issuer counsel because we're not taking companies public. I think the difference between the legal advisors and the other advisors is the legal advisors have a lane too, right? We're preparing the disclosure documents, we're filing the documents with the SEC, we're talking with the SEC, we're facilitating the stock exchange listing process, we're handling due diligence, we're negotiating other transaction documents and all the technical legal steps to get an IPO transaction done. In addition to our more direct granular role, we actually are basically weighing in at a high level on almost all the other areas of the deal and other work streams and functions. So I always think of the issuer counsel is more of the quarterback of the overall transaction. Obviously, most important is the company, obviously critically important bankers and auditors, et cetera. When I say we're the quarterback, we keep an eye on the different work streams. So an easy example is the underwriters obviously play a key role. One of the things they do is helping with the company and on the roadshow. The lawyers will check in and say, how are the roadshow materials coming? Make sure that both sets of counsel have a chance to look at the roadshow materials, make sure that they're consistent with what our disclosure is. There's what I'll call legal documents. I don't want to get too lawyerly here, but there's legal documents that happen that the issuer counsel isn't involved in, but say the underwriter counsel is directly involved in, but we have to keep an eye on it and make sure it's getting done in time so it doesn't hold up the deal. We don't try to micromanage or get involved, but we have to keep an eye on it and be aware. So I think of an IPO as there's 50 work streams going on. You're the quarterback. You have to know what's going on in all of those work streams. You don't have to run every single one, but you have to make sure that they are all moving along. You anticipate any issues, that if you can help preempt or resolve those issues, and making sure that all those work streams are moving on efficiently and in a timely manner so that everyone gets into the end zone launching the IPO at exactly the same time. All those work streams have to get done by certain deadlines in order for that to happen. So I think if you have an experienced law firm helping you with that, it can be very helpful because, again, lawyers who've done a lot of IPOs have just seen a lot. We've seen a lot of contingencies. We've seen things that haven't worked so well, and we've seen things that have worked very well. You can get a lot of good input, practical transaction execution advice, not even legal advice, on how to get a deal done as efficiently as possible from a time and cost perspective, and allowing the company to do its job, run its business. Yeah, I guess that's probably maybe overly simplistic way, but I think of it, you're running. You've got to be back there. You've got to see everything that's going on. You've got to have 360-degree visibility, and you have to make sure that all the lines of communication with all the different constituencies in the working group are extremely clear. Stay ahead of the curve. You want to be proactive and preemptive and take initiative. You don't want to be reactive. They move too quickly. The stakes are too high. You should be always trying to anticipate everything and helping your client go through that process, honestly, as painlessly as possible. Yeah, from that perspective, if companies want to lean on your outside legal counsels for that kind of guidance.
Yeah, I could absolutely see that. And I'm also curious, are there any other misconceptions about IPOs or things that you wish CEOs and founders knew as they were thinking through this process?
There are probably several. Sometimes there's a tendency to underestimate the sheer amount of work and time involved and the disruption and distraction from the company's day-to-day business. Oftentimes, if I'm working with a company on IPO, we will have a 1 or 2 hour session with the management team and go over the whole IPO process, just literally walk them through it from start to finish. Just they can see the forest because we're going to get into the trees very quickly. And so this way they see it. And so it's not as shocking to the system about what a time sink it is and what an effort it takes. The due diligence process and how thorough that due diligence process is very surprising to a lot of companies. And you never underestimate a lawyer's ability to get in there and want to look at every document you've ever produced within the company. I do think companies might not be fully aware of the possible transition or shift they might need to make on the company culture. And we talked about that transparency, information flow, to maybe having to be a little more buttoned up than you might normally prefer just because of the regulatory considerations. That's a good segue into also not being surprised, not just by the IPO process, but what happens to you after you become a public company. There's a tremendous amount of time and cost needed to comply with regulations, SEC reporting, being aware of liability considerations and things like that, not being surprised by that either. I think it depends on the company. Some are surprised at the level of scrutiny they get once they're public. Nobody paid attention to us before, but now we've made this one blog post and suddenly we're getting all this backlash. So I tell people, depends on the company, depends on the industry. Honestly, sometimes it depends on your market cap. You may get more or less scrutiny, and the most innocuous things you say or do as a company might elicit feedback that you didn't anticipate. Sometimes good, sometimes bad. One misconception, the IPO market picks up a little bit more steam. You might see this. IPOs come in various sizes. So we have billion-dollar valuations. We have much smaller deals. We have companies raising 100 million. We have companies raising 30 million. One misperception I will say that people sometimes think a small cap IPO is easier, faster, cheaper than a large cap IPO. I would say from experience, the size of the deal is often inversely proportionate to the complexity of the deal. There's a lot of reasons for that. One is sheer resources, right? Smaller companies often have fewer resources. The other is that if you're a smaller company, everything that has a materiality threshold when we're thinking about disclosure, I tell the smaller companies, your materiality threshold is unfortunately a lot lower than, say, a much infinitely larger company. So what does that mean? That means a lot more things have to get looked at. A lot more things need to get disclosed. The SEC will probably ask a lot more questions because you're a smaller company, maybe your room for flexibility in terms of financials and operating performance than a larger company. And from a regulatory perspective, sometimes smaller deals raise more complex issues because they might not meet certain minimum thresholds required for listing on a stock exchange or getting sufficient analyst coverage after they become public. So I always say, again, this is level setting expectations. If you're going to do a small cap IPO, that's fine. There's many that are get done. We do a lot of them. They can be very successful, but just recognize that there'll be maybe a few more complexities and hiccups throughout the process for you to get there. I'm trying to think of any sort of other surprises. This one is maybe a little more nuanced, and it's less about the company and more about management, including boards of directors. Another thing we like to do with companies is it's not so much a tutorial, but more of a Q&A session with the senior management and board about how being a public company affects them personally. I think everyone knows how it affects you as a company, but just remember, when you're a director and officer of a public company, the great news is you're the director and officer of a public company, but the bad news is you're in the bullseye. There's litigation. If there's a shareholder suit, you are liable. You have due diligence defenses, but you're liable for material misstatements or omissions. You are liable for insider trading. There's, depending on what level you are in the company, sometimes everything about your compensation is going to be out there in the public domain. So you personally come under a lot of scrutiny and you personally are exposed to more risk. I even tell companies literally from an estate planning perspective, right? The value of your equity in a company has gone up tremendously. You might want to start thinking about even estate planning as you're starting an IPO process. So I always advise companies that we always offer, if your board members, this is newer to them, some board members are seasoned, have been through a lot, others have not. But if your senior management or certain board members want to have an hour talk with us about individual considerations as you're becoming public and things that you can get ahead of from that perspective, I think that's always a good thing to do because people don't like to be unpleasantly surprised. And part of a lawyer's job is to make sure that doesn't happen and be as preemptive and helpful as possible, giving that guidance ahead of time. And again, being preemptive and not reactive.
This has been amazing, Davina. I knew this would be a super interesting conversation. So thank you so much. I have one last question. We usually ask our guests what their take is on high performance companies and what sets those companies apart. In the case of an IPO, most companies only go public once. But I am curious because you've had so much experience. Are there any behaviors or trends, anything else that you think defines a high performance IPO, a more successful IPO?
Trust your instincts. You'll get great advice from investment bankers. You'll get great advice from other constituencies, certainly from the board and other members of management who've been through a process before. But I would tell a company, you go public when you're ready, not due to external pressure. I would also say from a high performance IPO process, prepare in advance in terms of having a robust and rigorous process already in place. across all aspects of the business: operational, sales, legal, external communications, financial reporting. Already have that in place. That goes hand in hand, obviously, having an experienced leadership team. It isn't strictly necessary that the team has to have gone through an IPO process before, but I think most people will recognize if you have an experienced leadership team, generally, some with pubco experience, some with IPO experience, some with both, some with none, but people that have that skill set to execute on these types of deals, the ability to multitask and think ahead, all important. Being realistic about life as a public company. I think we've talked a lot about regulatory costs, complication, time, but it really is such a transformative process in a company's life cycle. And obviously, this is one of the things I live and breathe doing IPO transactions, because there's something tremendously rewarding, even as an outside advisor, watching a company and their employees' reaction when they first see the ticker symbol come across in Times Square. It's just very fulfilling. And obviously, all the hard work that the company put in over all those years and the sacrifices that were made, it's just rewarding. And the last thought on high performance characteristics, I would say, adhere to best practices, not just the minimum necessary to meet whatever requirements you're trying to meet. The easiest example is corporate governance. There's a lot of scrutiny on public companies from a corporate governance perspective, diversity, equity, inclusion, ESG, climate change rules. I would just encourage companies, if you're going to be a public company and going to IPO, think about adhering to the platinum standard expectations. Maybe the rule only requires this, but you'll see other companies going above and beyond, not just from a governance perspective, but from an operational perspective. Adhere to best practices, less focus on just trying to do the bare minimum necessary to get by. I realize that too is sometimes easier said than done. Obviously depends on the company, but in terms of your question about high performance in the context of IPOs, I think those would probably the ones that come to mind initially for me.
Thank you so much for joining us. We really appreciate it.
You're very welcome. Very happy to do it. And thanks so much for the opportunity.
Thanks for joining us here at Good Revenue. If you liked what you heard, please leave us a review, follow the show, or share it with a friend. We're a news show, so it really helps other listeners find us. And if you have feedback, comments, or suggestions for episodes or guests, please reach out to us. You can find our information in the show notes.